presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak Market Wrap YouTube weekly update for February the 20th, 2024. I'm Mo Ansari, President of Compak Asset Management, and thank you for joining me today. First of all, I want to remind all of you to subscribe to all the Compak communications. You can go to compak.com/media, and you can get all of the updates there. And make sure you subscribe to this update. Just click on the subscribe button, and then whenever I do an update, you will get that automatically. Let's start with last week. The market finally gave up the gains we had had a down week after all the 8 weeks that we had up. The S&P was down 0.35% on the day, and that's what we saw on that. But the Russell still ended up gaining 1.17%. NASDAQ down 1.31% for the week. Looking at the best sector, that was energy. That was due to, I think, a lot of the problems in the Red Sea and with the Houthis attacking some of the tankers. That's why we're seeing the energy markets. Some materials did well, utilities did well because interest rates went up. And whenever interest rates go up, utilities do. Technology was the worst sector, and that is what pulled down most of the S&P because that has become such a large part of the S&P. Oil, which was up nearly $7 from 71 or nearly 72 to $78. So it was up nearly $6 a barrel. And that's, I think, got some people concerned that inflation might be a little bit sticky. And we did get inflation numbers that were higher than expected. And that also pushed back the expectations that the Fed is not going to lower interest rates in March. Now the market is grappling with the reality that we are going to get interest rate reductions, but not as many as they thought. Market was looking for 6 at one point, which I thought was overly optimistic. I think now we are going to see 3 interest rate reductions, maybe in the latter half of this year, depending on how the economy does. We have this excess amount of money still being absorbed into the system, and that is what is creating the growth in the economy. I think that is going to subside, and as that subsides, the economy is going to slow down. We did get retail sales, which are lower than expected. We saw housing starts and completions that were lower than expected. So I think we are going to see a slowdown, but this is being right now, that is not showing up in the GDP because of the tremendous amount of money that was put in by the federal government during the COVID. And that is what we're seeing right now. Interest rates were up. They were up from 4.17 to 4.30, which was a big jump. And that is also with the expectation coming to reality that we are not going to see interest rate reductions in the first half of this year, or maybe until June, but we're not getting one next month. That is when the next Fed meeting is. Looking at the growth, we are seeing inflation is still one of the main factors that people are talking about. Why? Even though we've seen inflation numbers come down from 9.1 to 3.4% over the last year and a half, but when you look at the major gasoline and then food, those are still sharply higher. And that is what people are feeling still, because that's where most of the money is spent by most of the people. Retail sales down 0.8, as I mentioned earlier. Industrial production down 0.1. PPI was up. That's the producer price index. Ex-food also up sharply. Housing starts decreased. So most of the economic data we got from a market's perspective was not that good. We do get the PMIs this week, and we get the initial claims for unemployment this week. Looking at the technicals, looks like we have made a third wave top, starting to roll over to the downside. Support is at 49.43. We're trading right now at 49.68 on Tuesday morning, and then that's the 20-day moving average. And then I think we could come down to the 48.21 area, 48.50, because this line is moving up. This is the 50-day moving average. It's moving up, and it will be about 48.50 by the time the market gets there. So that'll give us about a 150-point correction in the market, or a pullback in the market. But these are the daily charts, which are still giving us hope that we could see after this fourth wave decline, we could see the fifth wave to the upside. But when we look at the weekly charts, it shows that we've completed, this was the target of 5,051 to 5,051. We got exactly to that number last week, and now we're starting to roll over. So we will have to wait and see how the dailies and the weeklies resolve themselves. But last week, we did see a weekly reversal to the downside. That means we went above the previous week's high, closed below the previous week's close, and that is usually an indication that the market is going to pull back. How much, we'll have to wait and see. As I've said, February and March, I was looking for a correction of somewhere between 5 to 7% in the market. And that is a nice pullback, and it should get some of the froth out of the market. It should get more people scared again. And that's what we want to see. I would view that as an opportunity to take a look, another hard look at the market. But the support is at 46.50 on the weekly charts. That is pretty far away, the 20-week moving average. So we'll have to wait and see how far we go. NASDAQ completed its fifth wave top. It's rolling over. It's broken below the 20-day, now headed towards the 50-day moving average, which is 15,161. We're at 15.5 this morning. So I think we have some more room on the downside. We'll have to wait and see if 15.1 holds. If not, then we're looking at about 14.5 as the next support down here. Weekly charts, again, 16,212 was the number. That was the previous high that we made in 2022. Market has rolled over now. We didn't quite get to 16,212. We got to about 16.1, and from there we've seen this pullback in the market. Interest rates have gone up. I thought we'd end up somewhere around here, the 200-day moving average, but we've gone through that now, and just bouncing along back and forth, up and down is what we're seeing. But this move to the upside, breaking above the 200-day, is a little concerning that interest rates could remain a little bit higher than what everybody was expecting. Crude oil market took off to the upside, still looking at a fourth wave here. I think, again, this was a temporary blip up because of all the problems in the sea with the Houthis attacking the shipping lanes in the Red Sea, where a lot of the crude oil comes through. So we'll have to wait and see how that plays out over the next couple of days. Small caps, that's one thing that was up. It rolled over, came down, and now it's starting to sort of hold here. We'll have to wait and see if it holds or not. And that is going to be something that I would watch very carefully. If it gets below 196 at that point, I would definitely start to think about maybe not waiting again to that 188 area right down here, or maybe even as low as 185, which is the 200-day moving average. Those are my thoughts. Those are my views for February the 20th. Again, if you need help with your portfolio, go to invest@compak.com, invest@compak.com, and we can set up an appointment, or just call 800-388-9700, and we'll be more than happy to look at your portfolio, look at what you have, look at your risk profile, and adjust it to make it properly fit to what you're trying to accomplish. Those are my views. Those are my thoughts. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.